We keep hearing that inflation's cooling, but for most people, it really doesn't feel that way. Prices are still high in the places that matter. Housing costs, groceries, fuel costs, you name it. It's probably higher than it used to be. And with the Fed keeping rates higher for longer, a lot of investors are asking the same thing. What does that actually mean for markets? What does it mean for your portfolio? I'm Steve Martin, Managing Partner and Wealth Strategist here at SRQ Wealth, where we help families find their freedom by simplifying their financial lives. Let's talk about what's actually happening out there and how you can stay on the right side of it. You see, the Fed's challenge right now isn't simple. Slowing inflation without stalling growth. After 2 years of aggressive tightening, policy is finally restrictive, and that's exactly the point. High rates reduce demand, they cool prices, and they eventually restore balance. But the side effect is tighter financial conditions. You see, companies pay more to borrow, capital investment slows, and valuations, well, they have to adjust. For investors, that means you're in a stage where fundamentals, earnings, cash flow, quality balance sheets, they matter more than momentum or speculation. Headline inflation has come down from the highs, but underlying pressures, the wages, housing costs, services, those things are sticky. The question isn't whether inflation drops, it's where it settles. Clearly it's dropped from a bunch of highs that we saw 8-9% a few years ago. But now we live in a world of 2.5% to maybe 3.5% inflation. And that changes the math for every investor. That 5% money market yield that sounds so great, well, after inflation and taxes, your real return could be closer to zero. Heck, maybe negative. Did you know that cash investments are the only investments that virtually guarantee a negative real return? A real return is that return you get after taxes and inflation. That's why sitting entirely in cash feels comfortable, but it isn't a long-term solution. Markets are adapting to this new regime. Bonds are investable again. Short duration treasuries, investment-grade corporate bonds, and even select municipal bonds now offer yields that can be attractive, and they can serve as somewhat of a ballast in your portfolio. On the equity side, we're seeing a shift back to quality. Companies with pricing power, strong cash positions, and steady earnings, they're stealing the show right now. Growth still has a role, but speculative growth, businesses that depend on cheap capital, they face a tougher road until the borrowing costs normalize. Meanwhile, sectors like industrials, energy, healthcare, these boring areas, they show resilience, largely because they can pass on costs to maintain their margins despite these higher rates. Trying to time the next rate cut, it's tempting, but that's not a strategy, it's a guess. A better approach is to stay data aware, but plan driven. Revisit your investment strategy. Are you allocated to some arbitrary risk tolerance questionnaire? Or did your advisor truly find out your goals and then align them to your portfolio? Keep liquidity for near term, but don't let the fear of volatility stop your long-term growth engine. Buy stocks and then buy more stocks. The dividend growth alone will outpace the cost of living, and always, always, always stay diversified in high-quality investments. Avoid concentration and leverage unless you know what you're doing. They can make you rich, but they can also make you poor quickly. In short, stay flexible, stay invested, and stay informed. Interest rates and inflation, they just keep shifting. They always do, they always will. But clarity comes from context, not from headlines. At SRQ Wealth, we help our investors cut through the noise and create portfolios built for all seasons. I'm Steve Martin, and you've just taken another step on your journey to true wealth. We'll see you next time. God bless.